In this video, I will do a deep dive into how to have $150,000 income in retirement completely tax-free. Before we dive in, some ads may appear during the video. Your support allows this channel to keep sharing valuable retirement and investment insights for free. Let's dive in. Did you know that according to recent government data, the average American couple in the top tax bracket will see nearly 40% of their retirement savings consumed by federal and state taxes, simply because they lacked a cohesive withdrawal strategy? If you have spent your life diligently building a 401k or a traditional IRA, you are currently holding a massive tax liability that is waiting to explode the moment you stop working. Most high-income professionals and business owners are operating under the dangerous assumption that their tax rates will naturally drop in retirement. But with the passage of the One Big Beautiful Bill and the shifting landscape of Social Security taxation, you could actually find yourself in a higher effective tax bracket at age 70 than you were at age 45. The reality is that if you do not act now to restructure your capital allocation, you are not just retiring, you are essentially gifting a six-figure portion of your hard-earned wealth to the IRS. We are currently witnessing a fundamental shift in how retirement income is regulated in the United States. The introduction of the One Big Beautiful Bill has created a series of new tax cliffs that specifically target high-net-worth retirees. For years, the gold standard was to defer, and defer some more. But today, that strategy has become a trap. Between the new $150,000 senior bonus phase-out and the mandatory Roth requirements for catch-up contributions, the government is making it harder than ever to pull large sums of money out of your accounts without triggering a massive tax event. If your portfolio is weighted heavily toward traditional tax-deferred accounts, you are facing a future of required minimum distributions, or RMDs, that could push your income into the 37% top rate, all while triggering high Medicare IRA surcharges. This is why having $150,000 in income is not enough. You need to know how to have $150,000 in tax-free income. This matters right now because the rules for 2026 have introduced a unique window for liquidity management that the general public is completely ignoring. The IRS has updated the long-term capital gains brackets and the standard deduction limits, creating a high-volume opportunity for those who understand how to stack their income sources. If you are between the ages of 55 and 75, your next few years of tax planning will determine whether you live a lifestyle of abundance or one of compromise. Fresh videos on this subject are uploaded regularly to help you stay ahead of these legislative changes, but the core principle remains the same. The only way to beat the tax man in retirement is to stop playing by his old rules. Let us break down the framework for generating $150,000 in retirement income without paying a single dime in federal income tax. The first principle of this strategy is the 0% capital gains stack. For the 2026 tax year, the IRS allows married couples filing jointly to earn up to $100,800 in taxable income and still qualify for a 0% long-term capital gains rate. But here is the secret that most investors miss. That $100,800 limit is applied after your standard deduction. With the new 2026 standard deduction for a married couple rising to $32,200, plus the potential $12,000 senior bonus for couples over 65, you could effectively have $145,000 in total realized capital gains and pay exactly zero in federal tax. This requires a precise portfolio allocation where you are intentionally realizing gains in your taxable brokerage account up to that threshold. By doing this, you are stepping up your basis for free and creating a stream of tax-free cash flow that does not count toward your traditional income brackets. The second principle is the strategic Roth conversion ladder. If you have $2 million in a traditional IRA, you are sitting on a ticking tax bomb. To get to that $150,000 tax-free goal, you must systematically move those assets into a Roth IRA. The goal is to perform bracket bumping, where you convert just enough each year to stay within the 10 or 12% brackets. While you pay a small amount of tax today, every dollar that enters that Roth bucket grows tax-free forever, and more importantly, is withdrawn tax-free. When you combine $50,000 of Roth withdrawals with $100,000 of 0% capital gains, you have hit your $150,000 target with a 0% effective tax rate. This is institutional-level capital allocation that prevents your RMDs from ever becoming a threat to your liquidity. The third principle involves the use of cash value life insurance and asset-based lending. For business owners and high-income professionals, a properly structured whole life or universal life policy can serve as a private reserve in retirement. Under current U.S. law, you can take loans against the cash value of your policy, and because these are loans, they are not considered taxable income by the IRS. If you need an extra $30,000 to reach your $150,000 goal, taking a tax-free loan from your policy allows you to maintain your lifestyle without increasing your magi. This keeps you below the IRMA cliffs and ensures your Social Security remains largely untaxed. It is a sophisticated form of liquidity management that provides a non-correlated asset class for your wealth-building strategy. The fourth principle is the 199A pass-through optimization for business owners. If you are still active in your business or have passive ownership in an LLC, the One Big Beautiful Bill has made the 20% qualified business income deduction permanent. This means that 20% of your business income is effectively invisible to the IRS. By balancing your business distributions with your Roth conversions, you can essentially earn significantly more than $150,000 while keeping your taxable income within that 0% capital gains sweet spot. This is the ultimate global bridge for wealth preservation, as it allows you to utilize institutional-grade tax optimization to keep more of what you earn. Let us look at the math for a hypothetical couple, Sarah and James. They want $150,000 a year. They take $30,000 from Sarah's Roth IRA, which is 100% tax-free. They take $20,000 in Social Security, which, because their other income is structured correctly, remains 85 to 100% tax-free. They then realize $100,000 in long-term capital gains from their brokerage account. Because their taxable income after the $32,200 standard deduction and the $12,000 senior bonus is well below the $100,800 limit, their federal tax bill on that $100,000 is zero. They have successfully generated $150,000 of spendable cash while paying less in taxes than a teenager working a part-time job. This is not a loophole. It is the deliberate application of current U.S. tax law to a diversified portfolio. A common objection I hear is, what about my state taxes? This is where the $40,400 SALT cap expansion in the 2026 bill becomes your best friend. By utilizing your state and local tax deductions up to this new higher limit, you can often wipe out your state liability as well, especially if you live in a state with moderate income tax or high property taxes. Another question is whether this strategy works for single filers. While the thresholds are lower, the principle remains the same. A single filer in 2026 can still stack the $16,100 standard deduction with the $50,400 0% capital gains bracket to reach over $66,000 in tax-free income before even touching their Roth accounts. To implement this, your first action step is to conduct a multi-account inventory. You need to know exactly how much you have in pre-tax, post-tax, and taxable buckets. If 90% of your wealth is in a 401k, you have work to do. The second step is to start your Roth conversion plan immediately. Every year you wait is a year of potential tax-free growth lost. Third, if you have a taxable brokerage account, stop reinvesting your dividends. Use those dividends as part of your tax-free cash flow strategy, now to avoid building a larger future tax liability. Finally, consult with a fiduciary who understands asset-based lending and the nuances of the One Big Beautiful Bill to ensure your estate planning is aligned with your income goals. In summary, having a $150,000 tax-free income in retirement is not a dream. It is a mathematical reality for those who use a 0% capital gains stack, a Roth conversion ladder, and strategic asset-based lending. We have covered how the new $32,200 standard deduction and the $12,000 senior bonus create a massive tax-free floor. We explored why the Roth mandate for catch-up contributions is actually a blessing in disguise for your future liquidity. And we discussed how business owners can use the permanent 199A deduction to shield their hard-earned profits. The cost of ignoring these rules is $100,000 or more in unnecessary taxes. The value of acting today is a legacy that remains entirely in your hands. If you found this breakdown of the 2026 tax-free retirement strategy valuable, and you want to stay ahead of the curve as fresh videos on this subject are uploaded regularly, please click the thumbs up button to give us a like as a thank you for this valuable content. It helps the algorithm share these institutional secrets with other investors who are tired of overpaying the IRS. If you have a specific question about the 0% capital gains brackets or how to structure your Roth ladder, please comment sharing an idea from the video content or any questions or concerns you have. I enjoy reading your insights and answering your most pressing concerns. And make sure to subscribe to the channel so as not to miss our next deep dive into the high-bid strategies that the wealthy use to stay wealthy. I am not your financial advisor. The information provided in this video is for educational and illustrative purposes only and does not constitute investment, legal, or tax advice. Every financial situation is unique, and tax laws are subject to change and individual interpretation. You should always seek professional advice from a qualified fiduciary, CPA, or tax attorney before making any significant financial decisions or implementing the strategies discussed today.